Owner finance, it is an important part of real estate. Whether you're buying or selling, there are all kinds of things you need to consider. And today we're going to talk about top mistakes people make with owner finance. So stay tuned to this episode of The Den.
The Den, powered by the Lyons Group, a show that explores trending topics in real estate, entrepreneurship, and personal growth. We're a small team of professionals with over $400 million in sales and nearly 2,000 successful transactions. You're listening to time-tested experts and industry leaders. Here's a refreshing look at real estate happenings and more. Welcome to The Den.
Owner finance in real estate is a tool that we use to help buyers and sellers who may not be able to get conventional type of financing. But there are pitfalls, and today we're going to talk about the mistakes that can be made that can be very costly. But today I'm mystical, magical mistake maker because you don't want to make mistakes in real estate, especially with owner finance. I've made plenty of mistakes in my life. I've gone to Lollapalooza.
Mine was Coachella.
Was it Coachella?
It was a mistake. I hated it.
Was it bad?
Yes. I don't think I'm a festival girl. I like...
Too many porta potties or?
Yeah. And they're like walking for like a mile, like through the dust. I was like, what are we doing here? We're too old for this.
Yeah.
I think I was like 24 and I was like, what are we doing here? Not for me.
Speaking of mistakes, Paul.
Thanks.
Let's dive right into it. Owner finance. Why don't you give us a rundown real quick of what owner finance is so our audience can understand what we're talking about?
Well, thank you, Ben, for putting me on the spot. Owner finance is, like you said in your intro, when the buyer can't get conventional financing, either due to their financial situation or because the property sometimes does not qualify for traditional financing. So what happens is the buyer and the seller will get together, negotiate terms. The seller will act as the lender. So they will finance the loan for the buyer. They negotiate price, interest rates, the term of the loan, if there's any balloon payments, down payment. If you do it right, it could be very advantageous for both sides because you don't have all the rules of traditional financing.
Yeah. And sometimes it doesn't have to be a situation where it can't go conventional or the buyer can't get a normal loan. Sometimes people just elect to do it because there's reasons why. The seller may want to make interest on their investment. Buyer may not want to go get normal financing or deal with the bank. So there are situations outside of just the property doesn't fit or the buyer can't get a loan that make owner finance a possibility or make it advantageous to both the buyer and seller. But having said that, just for a normal person to understand what owner finance is, if I were selling a property for $100,000 and Paul said, hey, I'm going to come in and put $10,000 down, we'll negotiate an interest rate and a term of payment, and then I'll make payments to you over the next 5 years. And after 5 years, I've got to get my own financing. That's in essence what we're talking about with an owner finance. Now, there's a lot of ins and outs to that and big mistakes you can make, and those big mistakes can cost you, whether you're a buyer or seller. There's mistakes on both sides that can be made and as a transaction as a whole, but that's what we want to talk about today. So Aspen, I'm going to jump to you first. If you're a seller, what would be one of the biggest mistakes you could make in an owner finance situation?
I think one of the biggest mistakes that you could make is, there's a handful, but I think the biggest would be if your buyers aren't actually qualified to buy the property and you negotiate, let's say, like you did, a 5-year balloon, and then that 5-year term comes and the buyers actually can't get financing on the property. You might be having to negotiate again or working on getting your property back, or what if they made really big changes to it? So if they're not actually qualified to purchase in the first place, I think that's where you could run into a really big sticky situation at the end.
Yeah, because then you're kicking the can down the road. Maybe they can make the monthly payment, but they couldn't qualify otherwise. And so then you're tied to that property for longer than 5 years or 7 or even 3 years. Oftentimes we do 3-year balloons where a buyer, it gives them 36 months to kind of get their normal financing in order, and the seller agrees to carry the contract for a while. But that's a big one because you don't want to be stuck at the end of that. And I think most of us are nice. There's some kind of mean business people out there that would say,
"What are you looking at me for?"
Well, I mean, what would you do in a situation where you got to the end of 5 years, someone had paid for their mortgage for 5 years to you, and then they come to you and they say, Paul, I can't get my financing. What would you do?
Probably let them keep paying my mortgage.
Exactly.
Yeah.
Yeah. And so,
which is a bummer for you because maybe you needed that balloon payment for something else. So a not nice person could say, not my problem.
You made your payments for 5 years. You didn't perform. And guess what? Property's now mine again, and I get to resell it. Or you're going to pay me some big, big penalties. And that's where I'm saying, like, it does harm the people that are nice, because you could take that money and put it somewhere else. You've had plans to pay for your children's college or whatever it is. Buy that new shiny boat or pontoon. You're a pontoon guy, aren't you?
What?
Buy that big pontoon boat you've been wanting.
I would not buy a boat.
Yeah. Well, you need to buy a boat because I need a friend that has a boat.
I've been saying that. Someone needs a boat.
Yeah.
Preferably a wakeboarding boat.
That's right.
I know a lot of people with boats, and I'm not of that kind. I don't know. I'm not a fishing guy.
Yeah.
My brother-in-law had a boat for a long time, and I was a hazard on that boat.
You get to frequent the boat without having to pay for the boat. So, but back to the mistakes. Shannon, what would be another major mistake if you were a seller and you had someone approach you with an owner finance situation? What would be a major hurdle that you would want to clear?
So I actually have a real life mistake to share.
Ooh, this
from
is
a
juicy.
seller. It was a seller mistake, but it was also a broker mistake. So I will admit my mistake. The mistake was on my part was that I trusted information given to me by the seller without verifying it tangibly, seeing it for myself. So my seller, this was during a very slow time in the market when you could not move a house, and they needed to move this house, and they did have a buyer willing to pay it, had a good down payment. They were business owners. They just couldn't do the financing at the time. My seller was fine with that. She didn't have a lot in the house. She was good with just getting some payments and getting it, just getting it off her plate. So when I first got the offer, we discussed, I want to say at the time, I don't remember the exact number, but the interest rate that was given to me was a little bit at market or just below market. And I had recommended maybe we counter back a little bit higher than market. I had asked her, how she felt about that interest rate, because we need to make sure that the rate we're taking in covers the rate in which we're reselling it, because you don't want their to amortize faster than yours. So I had the discussion with her. She said, you know what? I'm happy to have a buyer. I don't want to nitpick these things. I'm good with this. Let's go ahead and move forward. So we did. We accepted the offer. We got to everything over to the title company. Title company had it a couple weeks, ran the amortization schedule, which is where my mistake is. I had gone off of information that I was given by her. The interest rate was lower than what she was paying. And it actually would have amortized quicker.
Negatively.
Exactly. And so what we ended up doing, which she was in a fine position and she wasn't too worried about it. She said, look, I will make a $60 payment to escrow every month, for the 5 years we carry it. That wasn't a problem for her. She did that. That was worth it to her to not carry the whole house. She didn't care about it. To me, it was a massive blunder, in my opinion, because we can't go back and renegotiate that now with the buyer. I mean, we tried to, and the buyer was like, no, this is where my payment, this is what you accepted. I don't blame them for not budging on that. I learned a big lesson that day, because from now on, after that, I have said, I would like to see your bank statement.
Yeah.
I'm not going to allow them to make these kinds of decisions on their own. It is ultimately up to them, but I'm going to verify their information, and I'm going to make sure that I let them know all the consequences. So that was a big mistake. It could have been ugly. She didn't care. She was fine. She was happy. We carried it a couple of years. She still made great money off of it. The $60 a month was so much less than what she was paying to carry the home. She wasn't worried about it. Buyer was happy. But I saw the potential for a big mistake there.
Yeah,
that was a mistake.
And, deficit closing, title companies won't they will not close a deficit closing nowadays. So just to give our audience some context to this, let's say what Shannon's talking about is when an owner owes a mortgage on a property. Let's say I'm selling my $100,000 property, but I owe $50,000 to Wells Fargo and my payment is $500 a month. A new buyer comes in and says, hey, you know what? I want to pay you a really low interest rate and I want my payments to be $450 a month. And you agree to it. That's a deficit closing where your existing mortgage is higher than the new mortgage that you're getting. The new payment that you're getting doesn't cover that. And in that scenario, title companies won't close you because you could say you'll pay that extra $50 a month for the next 5 years, but what happens if you don't?
That's just it. If she hadn't been a trustworthy gal and done what she had said she would, the buyers would have been giving a down payment and then making payments to something that would have been short at the end of it. And that's a problem. But luckily, this was a long time ago. Everybody allowed that to happen. We learn over the years.
It was still willy-nilly back then.
Yeah. We learn over the years and things get tighter and a little bit harder to do. And they worked really good together and it turned out to be an A-okay situation. She was perfectly happy with it. But that's always stood out in my mind. It was over 20 years ago and it's always stood out in my mind about what a massive mistake that was. And it taught me a lot to say, I will no longer review a real estate contract with a seller and allow them to make that decision without having some documentation and running those numbers for them and showing them exactly what that's going to mean in the end. So I've changed my ways as well.
Yeah.
Hi, this is Aspen Groen. I'm a partner at the Lyons Group. We're dedicated to making your real estate experience the best it can be. If you're looking to buy or sell, go to sjcbroker.com and watch our informational video series. These videos break down the process and shed some light on buying or selling. While you're there, schedule a private consultation with one of our partners. We'd love to sit down, talk strategy, and give you a real advantage in today's market. You deserve the best, so take those steps and we'll see you soon. Now back to the show.
Paul, what about not closing through a title company? Are there any issues there for the buyer or the seller? Let's talk about seller in particular.
Not closing through you mean not transferring?
You mean like to escrow? Or just
not going to closing through a title company. Some people say, you approach me and say, hey, I want to buy your $100,000 property. I'll just make you payments once a month and we'll get it done.
Well, the important distinction in real estate contracts is the difference between equitable and legal title. Is that what you're talking about?
Yes, to some degree, but also what can happen if there's not merchantable title granted through a title company.
Okay. Yeah. So if your name does not get on a deed or get recorded anywhere, if it's not recorded, you have no legal right to that property. I mean, you could produce documentation for it, but if it's not recorded, it doesn't count. So when you do it through a title company, the buyer has what's called equitable title, which means they could sell the property for a profit, assuming that the seller gets paid off, but the seller has legal title. So if the buyer defaults, seller gets it back.
Yes.
Takes possession of the property.
Yes. I mean, that's a great point. So the buyer could, if you buy something so let's say Paul, in this example, buys the home from me on a real estate contract for $100,000 and turns around tomorrow and puts a sign out in the yard for $120,000 and sells it, makes a little bit of money. That's wonderful, but he has to pay me off. Right. But he also has to be aware that if we don't go through the proper channels, then you don't have an executed agreement or a properly performed deed. You don't have the equitable title and you don't, in some instances, could be removed from legal title. So there are reasons why you'd want to go through the title company because they do all that research and documentation for you, so you're not going willy-nilly there. And I do have an example of that. In fact, we had an instance many years ago. It was kind of a commercial building here in the downtown where an owner got with a buyer. He, wanted to do an owner finance. He was running his company, and they did not go through a title company. Well, when you go through a normal closing, the title company will research Paul, if he's the buyer, they'll make sure he has no liens against him, and me as the seller, make sure I have no outstanding liens against me and the property itself. In this instance, the seller did not do that. The buyer had federal tax liens against him. Guess what? Those federal tax liens attached to the property, because then he became equitable owner. The IRS saw that and they attached the liens to the property that he bought. Now all of a sudden she was in a position where she had an asset that had a federal tax lien against it, which was an incredible mistake and could have cost her big time. Thank goodness he was able to remove that lien by paying it off. But it was a shot across the bow in her instance, because it could have cost her tens of thousands of dollars in an instance. Aspen, what should sellers think about when they sell on an owner finance, how it may affect them with a new loan when they go out to get a new loan on another property?
So, you're not going to have that equity just off the bat to put into a new property. But if you don't need that, you still have that mortgage in your name. Now, you can produce documentation showing that you're getting monthly income from this, but typically banks are going to want to see at least a year. So if you are just trying to go from one to the next, you're probably going to have to qualify for both loans at the same time to be able to get your new property. Another thing I was thinking is property taxes and insurance. Who's paying that? Are we making sure it's being paid? Because if, let's say, the buyer is supposed to be paying it, we're talking about sellers, getting harmed. If the buyer doesn't pay that, now all of a sudden the taxes are, not there. What is it? Whenever they're not, I'm having a total brain.
When they're in arrears,
Yeah. And then the property can be taken away. So just because the buyer is not paying the property taxes, now they're in arrears, and that could really harm a seller, especially if, like you said, it's a large commercial deal, which in my experience, that is mainly what, the real estate contracts or owner financing are used for.
So you buy a property and you're supposed to be paying those property taxes and providing proof to the seller, and the seller doesn't check and you don't pay him, and 2 years or 3 years goes by. Guess who can sell that property and collect the back taxes? The county can. And they have. I've seen it happen. They've sold it on the block, pennies on the dollar, and all of a sudden the seller comes back and says, wait a minute, how did my property get sold? Because you owed these back taxes and you didn't pay attention and the buyer didn't pay them. So everybody lost out in that instance. Great.
And that could actually go the other way too. If you don't use a title company and no research has been done and those things aren't prorated at closing, consider the fact that that seller may be selling it on a real estate contract because they do have a couple years back taxes. And maybe it is in, it's a distressed property at this point. And then they turn it over. And in that contract, they have put that you are responsible for all the property taxes. And now as a buyer, you've inherited that. You've inherited their previous bills. It can go both. It can be devastating both ways.
Yeah, I really do think you need to go through the proper channels whenever you're doing an owner finance situation. You need to go through the title company. You need to have a lawyer review the paperwork. You need to have it held in escrow, because as the seller, whenever you're making the interest, I do think you have, a responsibility to be taking care of these things and checking on these things. It's not just, well, I'm taking all the risk. I mean, you are, but you need to cover yourself as well. Make sure that the property taxes are being paid. Make sure that they have insurance, but if you have all of these checks and balances in place, it just makes sure that it's fair for everybody. Things are above board for everyone on both sides. More eyes are better than less.
Yeah, and owner finance can be a wonderful tool if it makes sense for the buyer and the seller. But in some instances, one side is getting the rough end of the stick. And so that's where having all those parameters set before you get into the contract is really critical. Like, for instance, Paul, what would happen if I owed Wells Fargo $50,000 on the note, $100,000 property, and you as a buyer, let's talk about buyers and their harm, their risk, their mistakes. You're making a payment to me directly and it's not going through an escrow company. Are you just trusting that I pay the Wells Fargo note?
Well, I would never do that.
I know. I knew you would never trust me with that.
But if you don't go through an escrow company or another company that does kind of the same thing, you are, as a buyer, giving that money over and hoping.
You're renting.
Yeah.
You're renting and hoping that they're going to give you the house one day.
Yeah. Well, and if they don't pay, I'm going to be the one that's out the house. They're going to have the financial problems, but I'm not going to get to keep that house.
Right.
And all of those payments that I've made over the years don't count towards.
You're essentially being a second lien on the property. So if they go and they're not making the payments and it goes into foreclosure and they don't care because they got a big down payment from you and it covered what they needed. And I mean, it can be very tricky. And real estate contracts, owner financing are very common in New Mexico. I rarely do them in Colorado. It's just like, oh, that's like a last resort kind of thing. Versus here, I feel like they're more used as a tool.
Yeah.
I love owner financing, but go through the right channels to do it.
Well, there's so many benefits to owner financing, especially for a seller that doesn't need that money right away. If you've got, we're talking about the example with $100,000 house. If you don't want to take all that money in and pay your capital gains, you just want to take a little bit in every year, that's one advantage to it. Another advantage to it is collecting the interest. So, I mean, if I sell Paul that house for $100,000 at the end of it, I might have made, carry it for a while for him, and I might make $120,000 for it, far more than what I was going to make before, because I didn't need it anyway, and it was better for me not to take all the money in at once. There's a lot of benefits to doing it. I think sometimes people do them just because it gets them more money.
Yeah.
Not just because they have to.
Especially for like the large commercial deals, I think it really makes sense because you can negotiate a lower rate, but then, I mean, you could be making $1 million in interest just by carrying it for 5 years.
Right.
Most people will take that deal.
Right.
Especially if they're keeping the same business, everything the same in place, running it the same employees. I mean, it's still a risk, but it's a lot lower risk than just a house that someone's moving into.
Yeah, the interest is huge. I mean, it's one of those things that we used to bridge the gap when it was definitely more of a buyer's market where sellers just had to do everything that they could, be open to all options to try to sell. We may be back there one of these days soon, but back then it was like, look, this seller is wanting $100,000. This buyer is only wanting to pay $80,000. How do you bridge that gap? Well, interest. And so if they paid $80,000 for the home, but paid you a good interest rate, you could very quickly make up that $20,000 difference in interest payments in the first year or two.
Especially if you add a prepayment penalty, because otherwise someone could just say, okay, and then put a big payment towards it.
I'm going to take the good deal and then just pay it off early and not let them benefit from the long-term interest.
Yeah, put a large payment towards principal and then the interest is much less. So you do have to structure it in a way to actually do what you're wanting
it to do. And that's wonderful as long as both buyer and seller understand the rules of the game. What do you think about a balloon payment? Should you or should you not typically build in a balloon payment? A balloon payment for our audience is a balance paid in full to the seller in most instances. Now you can build in smaller balloon payments, $5,000, $10,000, $50,000, whatever else. But typically when we talk about a balloon payment, it's, hey, you need to pay me in full by getting your own new financing. You got to pay me off within a certain period of time. What do you think? Should that be built into most contracts?
Yes. I build it into all of them and they're always different. Sometimes it's one big balloon payment. Sometimes it's 10% every January. But yeah, I think you should definitely build it in. But as long as you're aware that they're going to change if you pay additional towards principal. Yeah. As long as everyone's on the same page about that.
Yeah. Shannon, what are your thoughts on balloon payments?
Well, it depends on what your goal is. I mean, if I have a property and I just kind of want this to be my retirement and I want that, that payment for the next 20 years, there's nothing wrong with carrying it that long if that's my goal. But the balloon payment's nice because in a lot of times people are, if they put their house on the market or a property on the market, they're wanting to sell it and they're wanting to cash that out. So if they're going to do that for somebody, typically sometimes they say, okay, we'll give it a couple of years. So yes, most people want a balloon payment in there. They want to know there's an end to it in just a few years. It's just a short-term thing. But really, not everybody is like that. I've known several business owners that have just wanted, I just want that steady income for the next 20 years. They're okay with it. They're okay carrying it for 20 or 30 years because that's just part of their income stream.
Yeah.
I feel like the balloon payment's nice because you can always renegotiate more time. It's not, well, you have to do it now. Some cases it is.
Yeah.
But sometimes if you're working with the buyer and seller, it's just, a more personal deal. You can add another 5 years on, renegotiate terms. Maybe interest rates went down. And as a buyer for you, it makes sense to negotiate that interest rate down a little bit. Or they went up a lot. And so the seller can make a little bit more on interest, but carry it longer. So, it kind of turns into like what is it? I'm like totally blank on everything today. The adjustable rate mortgage, where sometimes it's higher or lower.
It's like having an adjustable rate mortgage. Yeah.
It's a risk one way or another, but it's nice to have the option.
Yeah, it's not for everyone, but for people that need it, it's definitely a way to get things done.
Yeah.
Yeah. I typically build in the balloon payment, but there are instances where my in-laws sold us one of their properties. They just wanted the income.
Right.
So we just amortized it for 15 years and they know they've got a set amount of income for the next 15 years. They love that. And I love that because, we were at an interest rate that worked well for both of us.
And there's no pressure for you to figure out what you're going to do with it in a couple of years.
Yep. But it does make sense to put out in most other situations, build in a 3, 4, 5-year balloon payment because it allows you to kind of reset at that point. You can continue with the terms that you had, or if the market has gone totally the opposite way, there's opportunities to renegotiate on both sides. So interesting. Paul, jumping to you. What's the big mistake if you don't collect a big enough down payment?
In closing, if you're going through the title company with realtors, you might not have all your bills paid. So you have commissions, you have the fees at the title company, insurance and taxes that you got to get paid. So if you don't take enough, you could be selling your house and actually have to pay at the end.
Fair point. Absolutely.
One point before, I know we're getting short on time. A lot of people think that this is a rent to own or lease to own. This is not that. Yeah. So when it ggets recorded, the buyer it's their house.
Yeah, you do not call the seller to fix the
renters.
heater.
On the other side, I always have sellers saying, well, we're going to do an annual check. I was like, you can't do that. It's not your house. It's right. Their house.
Yeah.
You're the bank. The bank doesn't come and check on
There's
stuff.
Definitely that ownership component, but that also keeps people in the game more. But we get a lot of calls, and I think the general public doesn't know how to distinguish that. They like to call and say, I'm just looking for a rent to own. Well, we don't do that. Yeah. We don't do that. Why would any seller commit to saying, if you pay me, $1,000 rent for the next, 20 years, I'll just turn it over to you. But in the meantime, you call me when the lawn needs to be taken care of, and you call me when the roof is leaking, and you call me. Nobody rents to own. So I think that, sometimes, people, I know what they're
Paul
thinking.
Did with his boat.
I don't own a boat.
I think that's what people think it is.
Yeah,
It's rent to own. And there's actually a lot more ownership and responsibility in it. Everybody would love to just be a renter until you turn the title over to them. Yeah. That's not going to happen. Nobody's that.
Well, and every seller that I bring a owner finance to, they think that's what it is.
Yeah.
I don't want to be a landlord. Yeah. Well, in this case, you're not going to be.
You're a bank.
But they won't.
You're an investor.
A lot of times they don't
understand. And sometimes it's the runway to get off the ground. So I use it as a tool oftentimes when the seller has a home that is a little bit harder to sell. They've got an interested party. Maybe they can't get their financing right now, but they're set up. Maybe they started a new company, or they're new, but they're being successful. They can clearly afford the home, but it's just not in the cards for them to get conventional financing. It's a runway that you can use for an owner to finally sell that asset. And so in many instances, it can be a great thing, but the big pitfalls are if you don't set it up properly, you can be in big time trouble, as discussed today. In fact, we're winding down on time, but with federal tax liens, with that money not going where it's supposed to, it's not paying the underlying mortgage, the actual property tax bills not being paid, being underinsured. In other words, people not carrying the proper insurance. You need all of that lined out before you do an owner finance. There's so many pitfalls. That's why you need a competent realtor by your side, holding your hand and taking you through the proper channels. So speaking of that, go to sjcbroker.com and schedule a private consultation with any one of us here at the Lyons Group. We'd love to sit down with you and give you an advantage in today's market, whether it's buying or selling, owner finance, residential or commercial, owner finance, any one of those. We'd be happy to help with you, give you an advantage in today's market. So thank you for listening to this episode of The Den. Until next time, we'll see you then.
Thank you for listening to this episode of The Den, powered by the Lyons Group. Hit the subscribe button to keep informed, and check the show notes below for direct links to our buyer and seller video series. The buyer and seller video series can give you an inside track on taking the right steps in real estate. If you'd like to learn more about the Lyons Group or to schedule a consultation, go to sjcbroker.com. Complex markets require complex strategies. The Lyons Group can give you a true advantage in any market. Whether you're buying or selling, residential or commercial, contact us directly at sjcbroker.com. We're time-tested experts with a client-first approach, and we'll see you next time in the Den.